have you. Just to say this isn't a fashion statement, I had an accident the other day, and I'm patching myself up. I'll just do a quick sort of introduction, and then I'll hand over to Jess to talk about some of the more technical stuff. So the talk basically is, the first slide after this is just who we are and what we do. We'll cover HMRC and their approach to crypto, mostly crypto trading, but they've covered the entire sort of blockchain Web3 kind of financial activity. Then we'll go on to sort of where mainstream business fits in with crypto blockchain activity historically up until now, and what the future holds. Then it will be talking about the challenges that people like us have on a sort of day-to-day basis, trying to keep track of this, and what users and participants have sort of been facing and trying to sort of keep track of what they've been doing. And then we'll talk about some of the sort of various solutions that are around there, and then wrap up with Q&A. Just quickly touch on who we are and why we're here. We run an accountancy practice. We do all the normal boring stuff that you'd expect from an accountancy firm, but we also, for the last few years, we've been specialising in crypto and more generally sort of any kind of blockchain sort of financial transactions. You name it, we've probably dealt with it in some shape or form. Largely crypto traders trying to do tax returns, but also people that get paid in crypto and startups, all sorts, even some blockchain VCTs and things like that. That's me, obviously. I will hand on to Jess in a minute, who does most of the sort of day-to-day kind of working at the cold face of this, with the sort of technical part of it. She'll talk about some of the as accountants, we sort of approach this from the point of view of tax and tax legislation and things like that, but this entire new kind of role has evolved around what you have to do to this data before you even get to the point of trying to do any sort of tax calculations. And just to also touch on one of the other reasons we're here, so we're launching, or in the process of launching, this new sort of initiative called Crypto Lab Scotland, where that we've sort of developed in association with Crypto UK that we're members of, who they're the sort of the trade body that represents crypto businesses around the UK, and they deal with government and HMRC and sort of development of tax legislation and things. So I'll come back to this at the end to talk a little bit more about it. And in the meantime, I shall hand over to Jess to go through the complex stuff.
Yeah, so I thought it would be good just to start on kind of the big question of HMRC and crypto. What is their approach? Why is it important that you do actually pay your tax and declare what you're due? And on that, I think there's a positive reason and there's a negative reason. The positive reason is that as a sector, as an industry, if we are showing that we are compliant and we are keeping up with what the government expects of us, and that means that we are much more likely to go mainstream. We can't go mainstream until we have banks on side, until we have governments on side. And anytime there's non-compliance, anytime there's a whiff of people hiding stuff, that's a big red flag to banks. Banks are, I'm sure you know, if you're trying to withdraw crypto from your banks or trying to set up any sort of business bank account for a crypto related business, it's really difficult at the moment. And that's not some kind of big state conspiracy. That's just the fact that banks are commercial entities. They have really strict rules about money they're allowed to accept and money they're not allowed to accept. And so if we're compliant, that makes it a lot easier for us in the long run, because we're a much more trusted industry and we're much more regulated and much more accessible to big companies. The negative reason, and I think this is a really important one, is that HMRC doesn't care what you think. Like, it is your legal obligation to pay taxes. If you turn around tomorrow and you decide that you're ethically and morally completely fine with murder, that doesn't mean you can go and kill someone and say, oh, it's just part of my ethics, like I'm allowed to kill people now. And tax is exactly the same. You might not like it, you might think, oh, the government's stealing my money, I'm ethically not okay with this. But at the end of the day, we live in a country where you legally have to pay your taxes, you legally have to keep your data, your financial data, you have to keep a copy of that, and you have to comply with what the rules are. Which brings me on to this, which is what the rules are at the moment. So HMRC, at the moment, they have this big, scary-looking document called the HMRC Crypto Manual. It's not actual legislation, but it's the guidance that they've issued at the moment for how crypto should be treated. So there still are a lot of grey areas, but we do have the benefit in the UK that the way legislation tends to work is it's called like a common law system. So rather than a rules-based approach where in the States you can see there are a lot of issues with people saying, oh, this is the exact rule, therefore this crypto is something new and so it doesn't fit into any of the rules. Whereas we have much more of a kind of principles-based approach where HMRC say, look, if this looks the same as interest, then we're going to treat it like interest. If this looks the same as a loan, we're going to treat it like a loan. So that gives us a bit more scope and a bit more kind of background to work with as accountants when we are looking at HMRC's approach to crypto. Here's a kind of, I'm not going to go into the weeds of tax policy because I don't want everyone falling asleep here. But just a kind of high level, crypto assets are taxable assets, which is a pretty obvious one. Again, like treat it as if it was a non-crypto asset. If you're not sure what to do with it, imagine it wasn't crypto and think about what you do with it if it was just a normal investment. So anything from Bitcoin, shitcoins, NFTs, stablecoins, scams, all of it is taxable in its own way. They're subject to the 7 main taxes: capital gains, income tax, national insurance, etc. They'll all be reported either through your self-assessment tax return, which is due once a year, or through a corporation tax return if you set up a limited company and you do your crypto trading through that. From next year, it will actually have its own section in the self-assessment tax return, which is new, and it kind of highlights that HMRC are actually on top of this. They are actually going to try and put more effort into making sure that A, it's easy for crypto people to be compliant, but B, that if they're not, that they are getting called out for that and they are getting penalties. So trading and investing is almost always capital gains tax, and it could be anything. It could be buying a coffee using Bitcoin. It could be getting paid in crypto. It could be that you're trading, setting up a trading bot, buying digital assets. Whatever it is, they are all taxable events. Anytime you're disposing of any crypto asset, even if you're using it to buy another crypto asset, even if you're going from ETH to RATS ETH, that is a taxable event. And it's important that you keep records of all of that because you will ultimately be due tax on them. If you're paid in crypto, that's a really important tax planning point because you will be due income tax on the value of the crypto when you get it. So if you get paid in ETH and immediately ETH crashes, you still have to pay tax on the fiat value of ETH when you received it. So if you do receive income in crypto, that's a really, really important point where you should be planning your taxes ahead. Crypto mining is, again, it's income tax on any profit. NFTs, if you're creating NFTs, then that's seen as a job. Like an artist pays tax on their profits. The same way someone doing art digitally will pay tax on their profits. Staking is really complicated, so I won't get into that right now. Airdrops, again, you have to pay income tax. Usually, if it's just someone randomly unprompted airdropping into your account, then it doesn't count as a taxable event. But if you do anything at all, whether it's signing up to a Twitter thing or playing a game or anything, then you will be liable to income tax because it counts as doing something in receipt for income. And if you're a limited company, then any profits you have there will be liable to corporation tax. So just a kind of high level for anyone kind of new to the space or interested in the kind of bigger picture of where crypto business is actually going. This is something that's really interesting to us as accountants because we see that like our clients are such a varied kind of group of people that it's really interesting to see where the future of crypto is going. I'm sure most of you'll know that the kind of historic picture is that it's been fairly unregulated, so it's been hard for businesses to get into it. Bitcoin as a payment currency for various reasons, tax related and not, is not really taking off as a payment method. Most real life cases are B2B, which is business to business crypto transactions, so paying employees or paying suppliers in crypto. Blockchain startups mainly use this, and blockchain VCTs, but again, they have a lot of issues in terms of getting bank accounts and getting the tax right, which is again a really important point on why staying compliant is absolutely crucial for our industry. In the future, and it's something that we're starting to see more, is there are more and more startups. Now that the kind of trading era is coming to a close, we're seeing a lot more real building happening, whether it's Web3 or actually big companies like IBM are investing in a lot of blockchain supply chain management. So that's a really interesting use case where blockchain is used to track goods, especially with complex supply chains across the world. Something that we struggle with a lot as accountants is the kind of software element of blockchain, and there is actually a really interesting use case in terms of the security that blockchain offers could be really useful for a lot of accounting software and could kill two birds with one stone when it comes to doing taxes. And then the metaverse is also a really interesting use, and it's something that I think we're seeing a lot of businesses, from training surgeons to training pilots, all the way through to onboarding new employees during COVID and gaming. The metaverse is a really interesting one. And challenges for accountants. So this is kind of just more of an insight of kind of my job day to day. The technical challenges are mainly just that it's also new, and a lot of people aren't aware of their tax liabilities and their reporting liabilities, or their reporting requirements. So we have a lot of clients who come in and they say, oh, well, I've been trading crypto for 5 years. And I'll say, oh, well, that's okay, can you send me your data? And they say, I can't remember what I was doing 5 years ago. And so we then have to go through, connect the wallets that we can find, and then go through those wallets, and I can say, oh, look, it looks like you've been sending a lot of transactions to this address. Is this another one of your wallets? And say, oh yeah, we'll add that one on. And so we go through their data. And so my job, more than anything else, is a data job. I always joke that anything someone else can do in Python, I can do on Excel. Because there's just such a huge volume of often really complicated and not very clean data. And as an accountant, I come from a very traditional accounting background. My tool of choice always has been Excel. And so it's a big, heavy data job. Professional and ethically, it's a challenge again, because KYC and AML, which is know your client and anti-money laundering, can be really tricky. Especially if people are trading directly on chain. There's no name associated with the wallet, there's no KYC on the wallet. So how can I know whose wallet it is? And a lot of the time, like, there is the question of someone will say, oh, well, I want to split this wallet with my wife for tax purposes, or, oh, like, can I pretend half of it's my sister's or my brother's? And so that is a very common kind of thing that we see, and it's something that there is a big grey area around. Although generally we do have to say, if you put all the money in and you've been doing all the trading, then it's fairly clear in the eyes of the law that it is your property. So again, it's largely unregulated. The HMRC guidance is quite good, but there's still a huge amount of grey area, and there's still a huge number of questions. And so that's something that, again, it's a really interesting space in accounting, because we're seeing all these amazing new tech startups, we're seeing all these amazing new use cases for this technology, but it can be tricky when there are very few rules to go off of. And in terms of resourcing as well, trying to find people who have the necessary skills when it comes to data, and when it comes to understanding large volumes of data, who are also willing to maybe do the more technical side of accounting, is quite a tricky skill set to find. So even myself, I come from a very, very traditional accounting. I worked with a big firm in audit for 3 years before I came here. Now it's a completely different job, but I'm confident that this is the job of the future, and this is the job that accountants will be doing in the future as more compliance gets automated. There are also, again, a lot of challenges for the users of crypto because of the lack of regulation and the lack of clarity from tax authorities. Where are the assets all over the place? That's quite a common picture for us, and a lot of the times people will get all the way to the end of doing their tax return, and then we'll find 4 more wallets and we'll be back to the drawing board. There are more than 500 exchanges, many different wallets. A lot of people lose their wallets when it comes to scams, anything from FTX, and the FTX is actually a really good example of how complex crypto can be, because at the moment, because we're so early in the Chapter 11 bankruptcy case, we can't yet make a negligible value claim for assets in FTX, because you still own the assets, because ultimately you were only ever owed those assets by FTX. So you haven't lost them yet, so you still have to pay taxes on them, even though you can't actually get them out. And that will obviously change as the Chapter 11 kind of goes on, and we have a bit more clarity about what kind of returns investors are going to get. But there are a lot of tricky conversations telling people that yes, you got scammed, but yeah, you still have to pay taxes on that. And again, a lot of investors haven't done a tax return before, and are either really, really anxious about not wanting to go to jail, or convinced that it's fine and the government's never going to find them. And so there is a really interesting bit in the terms of client relationships where as accountants we're used to working with businesses or individuals who are quite used to paying a tax return, maybe in traditional finance. And so when you now have these people who've never done taxes before and have no idea what to expect, there's a lot more kind of education involved, which is something that as accountants we're really passionate about, making sure that our clients are both feel comfortable and feel like they're supported by us, but also that we support them to do things themselves, because there's a lot when it comes to taxes and when it comes to your data that sure we could do it for you, but actually if you're able to take a bit more ownership of that and you're able to get a bit more oversight of your own finances, that's both really beneficial to you and can help you when it comes to fees, because obviously any time we have to bill for it. So in terms of solutions and tools, there are some really good tools coming out now. Coinly is personally my favorite of the tax softwares. You can use softwares like Coinly. You can attach to your wallets. You can a lot of the time you can use APIs to get all of the data in one place, and it both gives you more of an oversight of actually where you're at in terms of gains, losses, because if you make gains on an asset and you're doing a lot of trading, your kind of tax won't actually just be what you sold it for minus what you bought it for, because there are a lot of rules, they're called like bed and breakfasting rules, where basically if you sell an asset and immediately buy it back afterwards, then they get matched together because they're the two closest trades. Like that, you wouldn't realize your profit on the time that you bought it before. The price that you bought it for afterwards would actually get matched. And the reason that that happens is basically to stop people trying to artificially realize losses. So you can't then on the day right before the end of the tax year, if you know that you're sitting on a massive loss, you can't suddenly just dump all of your assets and then buy them back the next day. So there's rules in place to stop you doing that, because you just you'd end up in exactly the same place that you started. So these tax softwares are really, really useful in making sure you have both a kind of like clear runway and knowing what tax you're going to have to pay and being able to come up with the funds, and also just when you are kind of reviewing your trading and understanding the profits you have made, it keeps all your data in one place. For accountants, again, you need a really fundamental understanding of how blockchain works, which is something a lot of accountants don't have. There are a lot of kind of crypto accountants who will go out, they'll read the HMRC manual on the tax rules, and then they'll suddenly decide that they're experts. But it's, like I said before, it's such a unique and such an different job than traditional accounting that you really do need a unique set of skills. Again, with technology, a lot of accountants, like we do like to live up to our reputation of being a little bit old-fashioned sometimes. There's a lot of accountants that still like to print out their bank statements. They like to work off of paper, and even as a very kind of forward-thinking firm, we still have a lot of clients that like to come and hand in a bundle of papers. And so it's trying to promote this technology and trying to see, actually, we need more people who are interested in tech and are interested in data, and that is the future, especially when we're seeing now, don't know if any of you saw AutoGPT coming out the other day, and seeing how many kind of menial tasks that could be automating in the future. It's more important than ever that accountants and really anyone working in financial services has a really solid understanding of fundamentals and can offer a lot more value than just inputting things into a sheet. I'll pass back over to Jason to wrap up.
Thanks. Yeah, so there you go. A lot of complex stuff going on there. So I'll just wrap up and I'll talk about the Crypto Lab thing. So yeah, like Jess says, well, we're just seeing a continued growth in inquiries coming in. We thought it would calm down after the sort of the market crash last year, and it did for a bit. But now people are starting at the end of the tax year again, and people are either wanting to work out how much they've lost or what their situation is. And so it's continuing to carry on like that. Regulations are coming. We're involved in quite a lot of talks with Crypto UK and FCA and things like that about what's actually happening in terms of regulation. FCA have up until now historically been focusing on the consumer protection sort of angle for things, to stop people getting involved in things that they shouldn't be. So that'll be what comes first, and then hopefully it'll roll out into more kind of proper sort of regulation with accountancy bodies and things like that. As Jess touched on, we're starting to see Web3 product touching mainstream business. We are approaching this from really sort of from the sort of professional services kind of non-crypto kind of side of the sort of scene. Accountants and advisors are now really properly having to start to get to grips with this, which we sort of feel that we're doing an okay job on so far. There's a massive skills gap in the sector. We're really struggling to recruit people. There's accountants, hundreds and hundreds and thousands of graduates coming out of university with accountancy and finance degrees. We interview people who don't even know how to use Excel. But they've got 2-1 in accounting, and they think that's it. You just go straight to professional exams and you become an accountant. So that's a huge challenge that we're trying to sort of address at the moment. And then at the end of the day, it's a huge amount of fun. There's a lot of quite crazy kind of situations that we come across on a sort of day-to-day basis. A few stories to tell. So just to finish, like I said, we're having this launch event on the 25th of May. We've got a few great speakers. Got Nick from Zoho, that some of you might know. Eleanor from Crypto UK, who's massively into the sort of DeFi kind of world. She used to be quite a big player in sort of mainstream finances. And Erica Stanford, some of you might have read her book. She's the expert on crypto scams. So we're hoping to get a good few, quite a lot of people along to this. Hear some brilliant talks and a kind of panel discussion, and then it'll be a bit of networking thing. So if anyone wants to come to that, just get in touch. It's 3 o'clock in the afternoon till